Opendoor stock has had one of the wildest rides in the housing market. In 2025, shares ripped more than 200%, with weeks where the stock was up over 180% and trading volume exploded more than 17 times above normal. In 2026, volatility is still extreme. Double-digit daily swings are common, and options are pricing in implied volatility around 100% or more. At the same time, Wall Street analysts say the stock is worth around $2 to $3 per share over the next 12 months, while the market is pricing it closer to $6 to $7. In other words, the stock is trading at more than double the consensus target. Layer on top of that a new U.S. administration talking about banning large institutional investors from buying single-family homes, mortgage rates stuck near 6%, and Opendoor's own promise of an AI-driven turnaround. So here's the real question. In 2026, is Opendoor an AI-powered housing revolution that's been mispriced by nervous analysts, or just the latest meme stock bubble being driven by retail traders and leverage? Let's break down the story behind the ticker. Section 1. What is Opendoor? The iBuyer model in plain English. First, what does Opendoor actually do? Opendoor is an iBuyer, a technology-driven home buyer and seller. The idea is simple. You go to their website or app, type in your address, answer some questions, and their algorithms give you a near-instant cash offer on your home. If you accept, Opendoor buys your house, takes ownership, does repairs or light renovations, and then lists it for sale to another buyer. They aim to make money on the spread plus fees and ancillary services like financing. In one sentence, Opendoor is trying to turn selling your house into something as fast and digital as selling a used phone online. The company becomes the instant buyer, so you don't have to wait. They've also pushed into self-guided home tours and mortgage products, trying to become a one-stop online real estate platform. But there's a crucial point about this model. Unlike a pure marketplace like Airbnb or Zillow, Opendoor isn't just connecting buyers and sellers, it is taking inventory risk. It buys thousands of homes onto its own balance sheet. If housing prices move against them or if demand dries up, they're the one holding the bag. That risk showed up painfully in 2022 and 2023. As mortgage rates spiked and transaction volumes fell, Opendoor was forced to sell many homes at a loss, leading to more than $1 billion in losses at the peak of the downturn. Since then, the company has shrunk its footprint, cut staff, and tried to get smaller but more efficient. That's where the AI and software story comes in. Section 2. The triple crossroads: policy, rates, and AI. To understand Opendoor in 2026, you need to look at three intertwined forces. First, Trump's housing policy and the threat of banning large institutional home buyers. Second, the end of the extreme high-rate era in mortgages. And third, Opendoor's own AI-driven Opendoor 2.0 transformation. Let's go one by one. 2A. Trump's housing policy. Is Opendoor in the crosshairs? The new administration has floated a bold idea: ban large institutional home buyers from buying single-family homes in order to curb rent increases and make housing more affordable. Headlines sound simple, no more Wall Street landlords, but implementation is complicated. On paper, the targets are long-term landlords and giant funds that buy homes to rent them out for years. Think big private equity and REITs that hold tens of thousands of houses. Opendoor's business is different. They buy homes in order to resell them quickly, not to hold them as rentals. They argue that they are a transactional platform, not a landlord. Opendoor's leadership has already gone on record saying essentially, "We're not institutional investors. We don't buy homes to hoard them. We help regular families buy and sell homes." That's their defense. But here's the key issue for investors. It doesn't really matter which label the company prefers. It matters how regulators and lawmakers decide to write the rules. If the final policy explicitly carves out short-term resellers and iBuyers like Opendoor, the company might actually benefit. Competition from long-term institutional buyers would be reduced, and Opendoor could position itself as a pro-consumer technology platform aligned with the policy goal of helping real households move. If, on the other hand, the definition of large institutional investor is broad and focuses on any large-scale large-scale corporate buyer, regardless of holding period, Opendoor could be swept into the ban or restricted indirectly. That's why when the policy was first discussed, Opendoor stock sold off sharply. The market initially painted all large corporate buyers with the same brush. When management later clarified their position and argued for a distinction, the stock rebounded. For now, the policy outcome is a major unknown. Investors are effectively betting on the fine print of future legislation or regulation. 2B. High mortgage rates. Are we past the worst? Next, interest rates. The U.S. 30-year mortgage rate, which was around 3% during the boom years that fueled Opendoor's growth, has been hovering around 6% or more. Forecasters generally expect rates to drift lower, but not to go back to ultra-low pandemic levels anytime soon. Why does this matter so much? Opendoor's business is extremely sensitive to transaction volume and holding costs. First, when rates are high, fewer people move. They don't want to give up their cheap existing mortgages. That means fewer homes to buy and fewer buyers when Opendoor tries to resell. Second, high rates also mean Opendoor's cost of capital and holding costs are higher. Each day a home sits on their books eats into margins. We've already seen the impact. As rates surged, Opendoor's volume dropped, and the company posted huge losses when it had to clear inventory into a weaker market. In more recent quarters, management has intentionally shrunk the business, buying and selling fewer homes to protect profitability. Revenue in one recent quarter was down more than 30% year over year, even as margins improved. So the rate story is this. Modest declines in mortgage rates could give Opendoor some breathing room, higher transaction volumes, slightly easier resales. But as long as rates remain structurally higher than the 3% era, the hyper-growth iBuyer dream is much harder to realize. Investors need to ask, what if rates only fall slowly and settle in the 5 to 6% range for years? That scenario may support survival and selective growth, but not necessarily the explosive expansion many bulls are still hoping for. 2C. The AI transformation. Opendoor 2.0. The third pillar of the story is technology, specifically AI. New leadership at Opendoor has pitched a reset, Opendoor 2.0, positioning the company less as a reckless home flipper and more as a disciplined AI-driven real estate platform. They highlight several tangible changes. One, faster algorithmic pricing, moving from manual or semi-manual underwriting to AI-driven models that can price a home in around 10 minutes, not hours. Two, operational efficiency. They claim to have cut operating expenses by about 40%, in part by automating workflows and using AI in customer interactions, risk assessment, and logistics. And three, improving unit economics. Recent quarters show positive gross margins around the high single digits and positive contribution profit, a dramatic change from the periods where they were losing money on many homes they sold. This is real progress. It suggests the original idea, using data and software to trade homes profitably at scale, might be viable under stricter, more disciplined parameters. But there are still big caveats. First and foremost, the company is still losing money overall. Net income remains negative. On top of that, revenue has fallen as they've pulled back on home purchases. They're becoming smaller and more selective, not yet proven at large scale in a tougher rate environment. And finally, they still hold billions of dollars in home inventory at various points, and that risk doesn't disappear just because pricing models are smarter. So, is the AI story hype or reality? It's partly both. AI is clearly helping improve speed and cost, but it hasn't yet transformed Opendoor into a high-margin, asset-light software company. For now, it's a more efficient, more cautious version of the same basic business. Section 3. Valuation and the meme stock overlay. Now, let's talk about how the market is pricing all of this. On the fundamental side, Wall Street analysts are deeply divided, but the median 12-month price target clusters around $2 to $3 per share, with a wide range from under $1 to about $8, reflecting very different views on survival and profitability. On the sentiment side, the actual market price has been trading in the $6 to $7 zone recently, more than double rival the median target, which means investors are either much more optimistic than the average analyst about how the AI, policy, and rate stories play out, or are simply treating Opendoor as a speculative trading vehicle, not a discounted cash flow story. And this is where the meme stock angle becomes impossible to ignore. Opendoor has displayed nearly all the classic meme stock characteristics. First, there is very high retail ownership. Roughly half of the shares are held by individual investors, which is unusually high for a company of this size. Second, we see repeated short squeeze episodes. At times, more than 20% of the tradable float has been sold short, creating the conditions for sharp, violent short squeezes when sentiment flips. And we've seen explosive rallies where the stock gained around 180% in weeks, with volumes soaring multiples above the average. And finally, there is extreme options activity. Options implied volatility has spiked to triple-digit percentages, with traders piling into short-dated call options, amplifying moves through gamma squeezes. Financial media and data providers now openly label Opendoor as one of the notable meme stocks of 2025, driven by retail frenzy and social media chatter. So where does that leave us? Opendoor today is not just a meme stock with no substance. It has a real business, real technology, and a genuine attempt at transformation. But it's also not a boring, mispriced value stock that analysts have simply overlooked. The current price bakes in a lot of optimism, plus a visible meme premium. Section 4. What has to go right versus what can go wrong. To make this concrete, here's how you might think about Opendoor for the next 2 to 3 years. This massive gap between the meme price and the fundamental value is exactly the kind of puzzle that keeps investors up at night. Honestly, trying to weigh Trump's potential housing policy against interest rate curves and Opendoor's AI claims, it's exhausting. It usually takes weeks of digging. I needed a tool that could look at a complex, multi-layered situation like Opendoor, where macro politics collide with balance sheet mechanics, and give me a deep dive research report in 10 minutes, not 10 days. I built it to handle the heavy lifting of financial logic, so you can focus on the decision. I'm now opening it up to the public at alphapilot.tech. Because it runs on top-tier reasoning models to simulate these complex scenarios, it is a paid service. However, if you appreciate the depth of this video, I want to give you an edge. Check the link in the description to join our Discord or Telegram. Tag yourself as a Lynn YouTube follower, and I'll set you up with a free trial membership. Now, let's apply that kind of rigorous thinking to your portfolio. Let's look at the specific checklist of what needs to happen for the bulls to win. For the bullish revolution thesis to play out, you'd probably need policy clarity that favors Opendoor. First, you need policy clarity that favors Opendoor. The final version of Trump's housing policy must explicitly exclude short-term resellers, effectively treating Opendoor as a pro-consumer platform rather than a predator. 2. Mortgage rates that drift lower and stabilize. Next, you need mortgage rates to move down from the 6% area into the mid-5% range or below, which is enough to unlock more buyers and revive transaction volumes. 3. Execution on the AI-powered profitability plan. Third, you need strict execution on the AI-powered profitability plan. By around 2026, Opendoor must deliver on its specific targets. This means hitting break-even on adjusted net income, maintaining consistently positive contribution margins, and turning inventory faster without repeating the fire sale losses of 2022. 4. A healthier balance sheet and less dependence on hype. And finally, you need a healthier balance sheet that relies less on hype. The business must become obviously self-funding, so the stock stops relying on meme-like squeezes just to hold its valuation. If most of those things happen, today's elevated price could, in hindsight, look like an aggressive but rational re-rating ahead of the fundamentals. On the other hand, the bubble thesis gains force if policy casts a wide net. First, if policy casts a wide net and Opendoor gets caught under the institutional buyer umbrella, either directly through bans or indirectly through tighter capital rules, rates stay higher for longer. Second, if rates stay higher for longer or an economic slowdown hits housing volumes again, prolonging the low-volume, high-uncertainty environment. The AI efficiency gains stall out. Third, if the AI efficiency gains stall out. This would mean the company misses its profitability timeline, has to raise more capital, or suffers another major inventory markdown. Retail enthusiasm fades. And finally, if retail enthusiasm fades, as meme status unwinds, the stock could begin to converge toward more traditional valuation metrics, including analyst targets. In that case, current levels would likely be remembered as a meme-driven overshoot, not as the beginning of a sustainable compounding story. So, is Opendoor in 2026 a mispriced AI-driven disruptor or just another meme stock bubble? The honest answer is it's both. It's a real company trying to use AI and software to modernize one of the slowest, most painful consumer experiences, buying and selling a home. The shift to Opendoor 2.0 has already produced better margins and lower costs. It's also a highly speculative stock, with a history of meme-style rallies, heavy retail ownership, extreme volatility, and a market price that's already far above the median professional valuation. That means you're not just betting on Opendoor as a business, you're betting on three converging narratives. One, that policy rules will distinguish between short-term resellers and long-term landlords. Two, that mortgage rates will fall enough to revive volumes without crushing the economy. And three, that AI will meaningfully de-risk and deleverage a fundamentally risky model. If you believe in that convergence, Opendoor can be seen as a leveraged call option on the future of tech-enabled housing. If you don't, it's more likely a meme-inflated bubble sitting on top of a fragile turnaround story. Either way, this is not a low-risk, low-volatility name. It's a stock where your thesis on policy, rates, and AI execution matters as much as your view on real estate fundamentals. Use that lens as you decide whether Opendoor belongs in your research list or just in your watch list.